Welcome everyone. Episode number 38 of the Wide Lens podcast. I'm joined here with my co-host John Sim, and we're going to cover the hottest and latest topics in financial markets. We are recording this on Friday, the 24th of March, 2023, and we are semi-dressed up. I am anyway.
Yeah.
You're semi-dressed
I've got a collar.
up. Is that a collar?
Yeah,
collar. We're dressed up today. You had a meeting. We've got meetings. Looking forward to it. Let's quick wrap up for markets over the last 5 days and year to date. Here is the last 5 days. I'm just going to zoom in on this on my screen so I can see exactly what's going on. Aussie market, I'd say flat. S&P 500 pretty flat. Nasdaq up north of 1% again for the week. European stocks up almost 2%. Emerging markets up about 1.3%. And what have I included there? Ignore the yellow one. I think we're all good. I think I've duplicated here on EM. So probably the one that I'm more interested in is this year-to-date one. So let's have a look at this. We've got year-to-date. Look at the Australian market. It has just lost all the ground from February.
Yep, lost a lot of steam.
And so now Aussie market's down 0.63%. The S&P 500 is up almost 4%. I'm going to skip the Nasdaq for a sec, so I'm curious about that. The European stock market up about 7%, still holding up quite well. And emerging markets, I'd say flat. But check out the Nasdaq, right? Up over 16% for 2023 year to date for the last 3 months. Who would have thought 2022 had, the Nasdaq was down like 36% or something like that from peak to trough for 2022. And here we are, not that, 6 months later, and the Nasdaq's up 16%. Like,
what's your view on that?
I was going to ask you what your view on it, because I don't know. I don't know why the tech sector continues to rally as hard as it did.
Is it because it just got hit too hard last year and people seeing value?
Possibly. Some are saying that I don't know how true this is. If people are allocating money, where are they going to be allocating it to? Are you going to be allocating to the banks? I mean, the banks are underperforming the S&P 500.
Oh, look at regional banks in the US at the moment.
Well, the banking sector in the US is pretty shit at the moment, and I've got a chart on this later on which looks at relative performance of the S&P 500 to the banking sector. The banking sector is underperforming other sectors, which is a very rare occurrence. Typically, the banking sector is seen as the grease for the economy, which keeps the thing clicking along and running. And so whether it's investing in companies that are just cashed up, right? Microsoft, Apple, Google. I mean, if they're the companies that's dominating that particular sector, and if you need to decide where you're going to deploy your money, are you going to put it in treasuries and bonds? Maybe, but if you need to allocate it to stocks, where are you allocating it to?
Yeah,
maybe you're allocating.
And a lot of these businesses they've cleaned up their operations. Spitting out free cash flow now. Really cutting out a lot of their middle management. So much. You mean like
hiring?
Yeah.
The
employee count.
Yeah.
Yeah. They've I think was it Facebook who announced more cuts in FTE, full-time employees. So they're managing their operational costs pretty heavily. So I think maybe a lot of people are seeing value in those businesses now.
You're probably right. I'm just curious. Just want to know how much cash Apple has right now. $51 billion in cash.
Wow.
On hand. And that's, back in 2020, so a few years back, that was 63 billion back in 2020. So it's come down a little bit, but it's down $12 billion. So if you're investing in, why would you want to be investing in banks, right? If your capital is at risk as an equity holder, right?
As an equity holder, right. And their tier one capital now is impacted, right?
Well,
you look at the Credit Suisse story.
Correct.
and they're basically note holders, all bag holders now.
Yeah, that's right.
I've got a good Twitter
Oh, dear.
screenshot
Okay.
from later on.
Let's jump straight into it, and over to you.
So, look, the Fed's having a bit of a gamble at the moment, as we saw in the last couple of days. So, Fed raised their rates again, which was, I think, unexpected.
Do you think it was unexpected?
Well, I thought they would hold, but it looks like they're still trying to get inflation under control. It's quite a tightrope that they're walking here between price stability and financial market stability, right?
Remember the ECB raised rates after...
That's right. We discussed that last week. Yeah.
Yep.
Right after the incident.
Yeah, that's right.
With SVB
Ruthless.
and Credit Suisse. So ruthless. So it looks like the US are playing the same game. And, whether we continue to see hikes or not, it's a big gamble. I mean, take a look at that headline. Fed opts for hike and see and gamble that crisis will stay contained. So what's the bond market expecting out of this? If you look at that next graph, you'll see that traders don't believe the Fed rate expectations are going to continue up, right? So they're predicting a drop there.
But the traders have never believed what the Fed was going to do for the last 12 months.
That's true. That's true.
There's always just been this disconnect between
massive disconnect between what the market thinks and what the Fed's doing. So whether this actually plays out or not will be interesting, and who's right in this scenario. That's the question. Is the bond market right, or does the Fed still believe that that they're not going to be able to keep inflation under control and continue to raise rates, right? So
is this a 10-year? Oh, it's a 2-year.
2-year.
So
the short term.
So it's showing 2-year Fed's end 2023 policy rate forecast is
of just
5.25%.
5.25%.
And what's the market saying? A bit
market saying it's gonna
4.25. So there's like 100 points difference between what the market is saying, what the Fed's saying.
That's Fed end forecast for 2024.
Of 2024.
So the market right now is saying 3.94.
Of 394. Gotcha.
Yeah. On the 2-year. So that's quite a divergent, I guess, expectation. Although not too bad, about 30 bips from 2024 if we're taking the Fed policy rate at the end of 2024. But just shows they're taking a bit of a gamble on whether they're going to break the system, right? I think it's really interesting how far they're going to try and get inflation under control. And if they go too far, they've got some significant risks because as we saw last week, there was 5 banks blow up, and if that could just be the start of underlying issues in the banking market. Right?
This is Powell. We are committed to restoring price stability, and all of the evidence says the public has confidence that we will do so. What fucking confidence is the public showing that the Fed is going to be able to land this thing? It is important that we sustain that confidence in our actions as well as our words. Likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It's too soon to tell how monetary policy should respond.
I mean, look, the speed of the bank runs last week was just incredible.
But did they just take one last shot? Like, let's just get one away. We go 25, because they were talking 50 bips last time.
That's right. And they were contemplating whether they don't raise it at all. So they've gone sort of halfway between that expectation just to see if they can stamp out inflation, right? Whether they end up doing that, that's an interesting question. And on your comment about Powell's confidence, I mean, look at the contrast to Janet Yellen had a speech at exactly the same time as Powell.
That was a mess.
Isn't it surprising? You'd think that they talk to each other and go, "Hey, maybe we should just be on the same page in terms of messaging."
What did she say?
She said, "What'd she say?" She said, "Look, after the Powell press conference, she said regulators aren't looking to provide a blanket deposit on insurance."
Right.
So, as we saw last week, the FDIC announced that they would make all SVB and Signature Bank depositors whole, but they obviously don't want to make a habit of making everyone whole all the time. So they've said, look, unless it's a systemic bank risk to the banking financial system, they're not going to bail out all deposit holders. So there's no blanket protection for everyone. Only if there's a systemic risk exception, they're gonna bail people out. So
it's almost like when they let Lehman Brothers fail during the GFC, and that was just like, it's almost like that started the whole thing.
That's the event, right?
That was it.
And there could be another trigger event where they go, hey, maybe we're not going to bail out this bank, and what's that going to do? So it's a fine line everyone's treading, and nobody wants to make any commitments to a certain thing, and everyone's still looking at inspiring confidence. But time will tell, and you'll just see from the next graph, if we pull that one up, in terms of the two comments from Powell and Yellen, what that did to the market. So it was...
So what's it saying? Powell and Yellen comments about sell-off. Powell says Fed officials don't see rate cuts for this year.
Yeah. And the market went up.
Well, what's the line? Oh, that's the index. Gotcha.
Yeah.
Powell said Fed will raise rates if it needs to.
And then Yellen says they aren't considering broad increases in deposit insurance, and basically
that's when the market just tanked.
Yeah, tanked. Fascinating.
I read an article. Apparently, the SEC, I don't know, whoever it is, maybe not the SEC, I can't remember what authority it was, had investigated Silicon Valley Bank back in 2022. And they were pinpointing and identifying a number of risks that are evident on their balance sheet, and it was apparently just going back and forth, and nothing really happened. They were on watch, and there was, and I can't remember exactly what was going on. I was reading the article the other day, and it was interesting how, like, why do those articles come out now? Like, no one, we never heard about this prior to the fact, and it's always after the fact that you start.
Yeah, I heard there was another one on Finding Alpha in December. That basically highlighted the risks of SVB.
It could have been the same one. Could have been the same.
Could have been
review.
the same article, and that's now just come out of the woodwork. So it's probably lost between all the other articles, right? People writing articles about all sorts of businesses, and I don't think a whole lot of people pay attention to that.
Have you seen the memes that are coming out with SVB? They're like, they'll show like an image of, I don't know, SpongeBob SquarePants with a magnifying glass, and it says, bank assessing my income and expenses for a $2,000 credit application. and then it's got another image. I can't remember what it was. I should have brought one up actually. And it says, SVB, what about their own balance sheet? No issue. It almost feels like that, right? Like there's just so much bureaucracy that goes on that,
what a disconnect.
Trying to resolve anything just becomes such a painful exercise, and nobody gets anywhere. And both of us have worked in the banks. We know what it's like. It's just such a massive jungle that trying to get anything to get from one to another,
I mean, what I'll say though is that, obviously here we have one regulator with APRA. Over there, you've got the tier 1 banks, which are more highly governed than the tier 2 banks. And that's now coming forward as an issue in terms of regulation of how these guys hedge their balance sheet, what they do with their balance sheet, and how they manage their business. So,
do you remember during the GFC, Australia spoke about how well our banking system was set up and how it operated, because we've got the 4 pillars and how good that was. And then Kevin Rudd came out talking about how we wanted to create more competition, and it's not so good to have anti-consumer behaviour and no diversification and option for banks. 15 years later, it happens again, and now the Australian banking system, and it's great. I think it works really, really well, relatively speaking. But if it's working so well, why do we sort of praise it when shit hits the fan, and then we just poo-poo it when things are going really well and we're in some sort of economic boom that things need to change? What do you think about that?
I think it's worth having the four pillars there as a structural protection for the economy. And what that means is, during the ebbs and flows, they may be not seeing, the whole amount of the upside because they've got to have liquidity and capital protections in place. But in the same capacity in the downturn, they're, well insulated and
but
well
don't
protected.
we already have that? Like, what about all the other credit unions? What about all these other banks? Like, it's like we forget about all the other banks and credit unions that we have. I don't understand. Do we not have enough? What do we want?
That's an interesting question. Isn't that sort of a market driver in terms of whether there's enough liquidity in the market? So more banks should technically appear if there's a greater requirement for it, right?
And look, I don't know what the process is with licensing and so on.
I heard it's pretty difficult.
Anyway, sorry, back over to you.
No, that's good. Look, if we go to where inflation is based on this, let's look at the next graph. Underlying US inflation, it's still quite heated up in February.
Yeah.
So still not quite under control. That's actually trending back up. So I can see why they've gone for another 25 bips. But
maybe the economy is just hot. Maybe the economy is just booming. And we've got this conundrum where we've got parts of the economy that are booming, but parts of the economy that are just shitting itself, which is tech. We talked about this last week or the week before where...
I still see this as a supply side issue, being that, we just can't generate enough produce or supply of goods to keep prices low. So there's obviously a limited amount of supply causing this inflation of in the economy, right? So I think that was all started in the trade war with Trump, those issues with the US, hawkish hardline views with the US with China, causing a lot of limitation and extra tax for goods that should have come cheaply into the US economy, and that has now caused an inflation in the cost of all these goods going around, right? And the only way now that they can get this under control is to control demand, which is continually pumping up the rates, reducing credit, and hopefully eventually reducing the actual demand for a lot of this produce or goods of basket or whatever it is, right? So, I mean, long story short, where could it go? Do they break the system? You think they break it? Or do they get inflation under control?
Deutsche Bank had this really good chart that showed going back, I think, to 1950, every rate hike cycle, something broke. Every single one. We've never gone through a cycle whereby the Fed has been hiking rates and nothing's broken at the end of it.
Well, they say you got to break a few eggs to make some omelets.
Don't know. Don't need eggs. But yes, I think so.
But it's an interesting one. Anyway, we'll see how it unfolds.
Talking about Powell, actually, did you want to chat about anything else on that chart, or?
No, I think that's all.
So Powell had his own chart. So I'll bring this chart up from Bloomberg now, and it's called the Powell curve. And so Jerome Powell came out, I think about a year ago, and he said, if it's inverted, it means the Fed's going to cut, which means the economy is weak. And it's the near-term forward spread, arguing that the part of the yield curve was the one worth monitoring rather than the classic recession measures further out with longer term. So I think it looks at, I think it's a 2-year and 3 month or something like that. So even on his own measure, the forward yield curve showing us that we're negative, but he's still turning around and saying we're still hiking rates. And so it feels like there's a disconnect there. It feels like the disconnect between what he's saying, what Yellen's coming out and saying as well, and just as you almost praised the authorities for coming out and having responded so quickly within a matter of days. They took over control over the bank, or SVB in particular. They made decision really quickly. I feel like that could have blown up much bigger than it actually did, and restoring confidence so quickly helped. Now coming out and making contradictory statements. I mean, obviously we saw what that did to the market.
Yeah.
So a couple of things here, why that's actually important, why that matters, is that a couple of bullet points here. When this market whips around wildly, you've got banks and financiers finding themselves unsure about the right price or the right rate to be charging borrowers for the use of cash. Obviously, I mean it's a measure that is used as an anchor where everyone bases borrowing rates off.
Yeah.
So if you don't know what that is, how do you apply lending policy that is prudent and thoughtful as it relates to margins and the economy and so forth? And so following on from there, what you'll probably start to see is a slowdown of lending. And if we're starting to slow down lending and we're tightening lending conditions, we start to sort of turn that tap off, then you find economic conditions start drying up. And maybe that's what they want.
I think that's what they want.
Maybe we get to the same destination or the same outcome, but we just take a very different path. And, we spoke about no one saw SVB or any other bank collapsing. No one was talking about any of that. So
completely left field.
Maybe we're getting the same outcome, but a different
if there's
path.
lower consumption, there's lower demand for products, and there's lower liquidity, meaning less lending. Hopefully, then inflation goes down. There's no more need for the Fed to hike.
But you're saying it in such a smooth and like orchestrated way. I just don't know if it's
more
going to
haphazard than that.
I think so. This chart from Torsten Slock from Apollo, current conditions for buying large household goods is bad. High interest rate and tighter credit. Like we haven't seen the degree of the slope for tighter conditions. The last time we saw this was during the GFC, 2008. So this is starting to push people and consumers right to the edge, I reckon. And it almost feels like everyone's just holding on for dear life for as long as they can, holding off.
Yeah. I was looking at a TV actually quite recently, and the price of a 75-inch OLED TV, it's come down 40%, I reckon, since I've been looking at it for 6 months, thinking about whether we don't have a TV at home actually. We just use the iPads and all that, and thinking about whether we get one. And I've just been monitoring it, and the prices really come off.
Doesn't that technology shouldn't get cheaper? Shouldn't it get cheaper? It's like a deflationary good rather than an inflationary.
It's very rapid in terms of the deflation, and it feels to me.
How much is a 75-inch? Like we've got a TV we never use. We're getting rid of our TV as well.
Yeah. Well, I saw an OLED that I wanted. I think it was a 75-inch for 1.3, and I was looking at it previously. It was almost 2.3.
Yeah, right.
Yeah. So it's
maybe deflation's coming in the Australian market as well.
Yeah.
Financial underperformance I want to talk about now. So this is from Bespoke. Over the last 4 weeks, the financial sector has underperformed the S&P 500 by over 10 percentage points, a margin that has only been experienced in 5 other periods. So I'll bring this chart up now, and you can see the S&P 500 financial sector, and you can see the red dots where the financials underperformed the S&P 500 by 10 percentage points in a 4-week span. There's 1991 where you see a rally in markets, you see a rally again in 94, you see some sideways action in 99, you see a massive decline from, what's that? That's a GFC. I'll bring this second chart up now, actually. Where are we? Here we go. So I'll look at this table actually. Have a look at this table. Performance of financials underperform S&P 500 by 10 percentage points. And then it's showing the 1, 2, 3, 4, 5, and 6 at the moment. It shows what happens when with the S&P 500 performance, and it also shows the financial sector performance.
I don't know about you. I'm finding it hard to draw a conclusion from all these points of reference.
That's the point.
Yeah.
You can't draw a conclusion. So it's very mixed. So Bespoke again, I'll quote Bespoke. The recent underperformance of the financials could be a canary or nothing scary at all. Unfortunately, this provides little insight from an investment perspective, but from a policy-making perspective, would seeing these numbers and the fact that two of them have occurred right before or in the early stages of the two largest bear markets in the last 50 years give you any sense of pause heading into a meeting on interest rate policy? In our view, it should, unquote Bespoke. But, I mean, that's the point. It's either done okay, or on the contrary, the margin's so wide, like it could do okay, or the whole world could just implode and we'll have another major financial issue or crisis. And what obviously the Fed have chosen to do is put the foot on the gas again. Yeah. Following on from that, I just want to talk about a couple of things in relation to the banks. So mid-sized banks have now come out. I'll bring this headline up actually. This is from Axios. Mid-sized banks plead for unlimited FDIC backstop for 2 years. So if you walked into, not that I've walked into any branch in the US, but if you walk into any branch in the United States now, they've got a sign that says FDIC, Federal Deposit Insurance Corporation, in big letters. And then it says each depositor insured to at least $250,000. So it used to be up to $250,000. And I think what this is highlighting for me, which is what you spoke about a moment ago, is the uncertainty around what all of this means for depositors. Is there a blanket rule that provides full coverage and every deposit will be made good, or is it not? And I think that's causing confusion amongst the banks, amongst depositors. And I don't think you can expect depositors to go and assess the viability of a bank where they deposit their money.
Definitely not.
How are they supposed to do that, right?
I mean, majority of them wouldn't be sophisticated enough to have a look through the financials and understand what's going on.
Credit rating agencies can't do it.
Yeah.
Fuck.
That's true.
Come on.
That's true.
Again, from Axios, I'll bring this chart up as well. I'm just sort of keeping on the banking theme here now. Small banks, big problems. Share of loans held by small domestic banks by select sectors. So obviously stricter lending standards among bigger banks are going to slow economic growth. But the big issue one here that everyone's now talking about in the US is the commercial real estate sector, which is already getting smashed with higher interest rates. Yeah. These regional and smaller banks make up almost 2/3 of lending to the commercial real estate sector. And so everyone's sort of now worried, and we're starting to see some articles being published here in Australia about the looming crisis as it relates to commercial real estate. Although the biggest issue in the US at the moment is office.
Yeah, and people are not going back to work, right?
They're not going back.
Yeah.
They're not going
back.
back.
So we've got all these empty office buildings which are funded by these regional banks.
Correct.
Breaching their covenants and
that's right.
Running into issues.
Yep. And
they can hand back the keys in the US, can't they?
Yeah.
So you've got basically banks holding title to all these securities that are potentially impacted on value as well.
And that's... I don't know what's going on with my headphones today. They keep falling off. Not enough our product in there. But I think that's a really good point you've highlighted, because I think we can people try and draw parallels between the US banking system and the Australian banking system. They're very distinct and they're very different. And so I don't think you can just apply whatever's going on there is going to happen. It's going to happen over here. Correct. As well. I think that's a really good point. A lot of B-grade office buildings are being impacted at the moment, especially in the US. And we're seeing it here as well, where landlords can't just give the keys back, first of all, in Australia. Here. But landlords are trying to revamp and trying to revitalise and create a very different experience for employees to come in if they're in B, C grade buildings. So I thought that was interesting. I didn't realise the scale for which smaller or domestic banks were providing finance to those particular sectors. couple of other things that I picked up. This was from Goldman Sachs. Before I bring any of these charts up, banks with less than $250 billion in assets account for roughly 50% of US commercial and industrial lending. They account for 60% of residential real estate lending. They account for 80% of commercial real estate lending and 45% of consumer lending. I'll bring this one up against commercial real estate.
It's a massive part of their economy.
It is. I never realised how big it was. And so if you look up here, small and medium-sized banks, I mean, previously we were looking at small before, but small and medium-sized banks account for about 80% of total commercial real estate lending. That could be...
Their small and medium-sized banks are the size of
our big banks.
Of our big banks.
Let's put it into perspective.
Yeah.
But if you think about this, you think about how important of a role these smaller regional banks play in the system. Surely the authorities and regulators are taking this more seriously than it appears from the headlines that you read in the paper.
Well, they obviously are. I mean, there's a whole raft of implementations. I mean, they pressured the bigger banks to deposit that $30 billion in First Republic, right? To maintain confidence in the regional banking system, and they're going to have to continue to support the system based on this. Otherwise, you'll have a banking-wide system collapse, and they can't afford that.
40% of loan officers, this is a survey that's done every single quarter, 40% of loan officers said they had tightened lending standards in the commercial real estate space during the last quarter of 2022. Only about 5% said they were tightening at the end of the previous year. So end of 2021, only 5% of respondents were saying they're tightening. Now almost half said they were tightening Q4 of 2022. So not only were they tightening then, now we've got this. Imagine what that's going to do to credit conditions.
Yeah. I mean, I'm surprised they weren't tightening earlier than sort of late last year.
Final chart from Apollo. More than $100 billion went into money market funds last week. And I came across a chart this morning that was from Bloomberg. I don't have it with me. But what it was money market funds and bank deposits. As money market funds were going up, bank deposits going down, dollar for dollar. Wow. And so people are just pulling money out of banks.
Is it into treasuries? And
yes. Short term. So it might be like 3-month treasuries to short-term money market.
Makes complete sense, right? You've got a government-backed security. Yeah.
Why would you go put in a bank?
Yeah.
And so people are pulling money out, and then these big guys have to go and use their cash to stump up their poor cousin down the road. So there's a lot going on at the moment. Look, I don't know how all this is going to end, but this is as noisy as it's been for a bloody long time.
Long time.
Not to say that it hasn't been noisy over the last 6 or 12 months, but it's just there's just something constantly going on right now. It just feels amplified.
I think we're on the cusp of something breaking even further. I mean, these are just the warning signs, right? Typically in these sort of cycles, we see a lot of warning signs flashing. I think cracks start appearing, like I said last week, and we'll see another left side event come
left
through.
Field.
Yeah, left field. Left field event come through in the next couple of months. Sorry, I'm lacking a bit of sleep at the moment. I've got the 2 kids.
Oh yeah, is Mel still away?
Myself. Yeah, Mel's
When's
away.
Mel coming back?
She's coming back next Friday.
When are your parents back?
6 weeks.
Far out, you are running solo.
Yeah, running solo. It's been good fun.
Over to you, mate.
So let's talk wider in terms of geopolitical issues. And
this is not an area of
power.
that I have any expertise in, but let's hear what you've got. What's going on?
Neither do I. I've been doing a bit of reading. I think it's fairly fascinating what's going on in the world in terms of China, Russia, what's happening in the Ukraine, what's happening with China and Taiwan, and now that Xi Jinping is the eternal chairman, and it's like a big game of chess, isn't it? When you think about how all this flows in global politics and how that flows to the global economy, and basically globalization and trade and what that's done over the last few years. I mean, the big headline this week has been China and Russia deepen nuclear concord that has the Pentagon on edge. So China and Russia, they had a meeting, I think, earlier this week as well, which was, looking at fostering greater friendships between them in terms of trade, all the rest of it, etc. I think they were looking at whether China would take on a big energy deal as well in terms of the Russian gas that Russia has that is now not going through the Nord Stream pipeline. But one of the big ones that has been raised is obviously nuclear. I didn't know this, but did you know Russia was the world's biggest supplier of nuclear reactors and fuel?
No idea.
Crazy.
It's like we didn't know that Ukraine was one of the largest wheat producers.
Exactly. So yeah, China's fast reactors, they use a liquid metal instead of water to moderate their temperatures, and that's based on a Russian technology. So if you look at the next graph, Russian nuclear exports are booming. So if you look at
who would ever think about these second, third order effects of everything that's gone on?
Oh, it's amazing.
It's fascinating.
Did you hear Saudi Arabia is buying oil from Russia?
No, why are they doing that?
So they're getting it at a massive steep discount because no one's taking Russian oil. They're taking that, using that in their local economy. So their local economy gets discounted fuel, and then they sell their fuel to the rest of Europe and to the US
no one's buying
at a higher price. So there's an arbitrage there, right? And you think of the effects of this. There's all these loopholes in these systems where people there's countries that are well placed to take advantage of.
So people are still not buying anything from Russia. Is that still going on?
There's massive sanctions. So Europe and the US, and I think we're involved. We can't take on any goods.
So
sanctions.
The Saudis are like, just fucking buy the oil, man.
Yeah, buy it at a discount. We'll sell our oil at a premium. All our local economy runs off the cheap oil, and we make more money. So I can't remember the stats, but they've purchased the most oil that they've ever purchased. I don't know how many millions of barrels that they've produced. But yeah, all these second, third order effects are coming. China's rejected US concerns that this is going to increase their nuclear stockpile of weapons. And they're trying to overtake the US as the world's top nuclear energy generator in the next decade.
Who?
China, trying to overtake the US.
Yeah.
In terms of nuclear generation.
Yeah.
So whether this goes to weapons or to the power grid, time will tell. But looks like us down here in Australia have our own nuclear agreements in place.
Yeah, I saw that.
Did you see that? So
just going back to your US China thing, I think if you look back centuries, different countries, different economies are in power. They're not in power forever. They rise and they fall, and I think China will eventually overtake the US, whether it's in our lifetime or not. I've got no idea.
Look, I think it's happening a lot quicker. There's a great article as well around the BRICS countries. So BRICS countries are the 5-nation bloc includes Chinese, the Russians, Indians, Brazilians, and South Africans. And they're actually looking at setting up a common single currency based on their basket of currencies as an alternative.
Like the euro. How did that go?
Well, we'll see. So they're committed to doing this, right?
So are the Europeans.
So are the Europeans. Yeah, we'll see where that goes. But is it a change in world order? They're looking at that.
Oh, so from that perspective, sure. I mean, we
yeah.
joke about currency, but
another headline's Egypt officially becomes member of the BRICS New Development Bank. So a lot of countries are now joining NDB, which is the New Development Bank, and so we've got the United Arab Emirates, Uruguay, and Bangladesh all becoming part of this, and the bank's aim is to provide funding and finance to BRICS member states, and that now means that BRICS has access to both North and South African Union.
What does that do to does that have less reliance on the US dollar?
Yeah, less reliance on the US dollar, right? So it's really interesting, right? Game of chess, effectively, that gives other countries now another reserve currency to play off. So it might happen faster than you think. There's this. So Egypt just joined. I think it was yesterday.
Right.
So there's a lot of global political changes happening, and the environment seems to be constantly shifting.
It's such a a specialized area of expertise. I mean, I've got no idea that Egypt joined the new development bank. But I mean, it's in the paper, it's making headlines. People are aware of it. I'm not smart enough for that stuff. I want to talk about stuff that's a bit closer to my heart, which is active, passive, ETFs.
Yeah.
So
I love this topic.
Your question last week about how ETFs. So Standard & Poor's index versus active, or the SPIVA results, they get released out every quarter. So I thought I'd just go back and bring up the back end of when we haven't got the first quarter of 2023 yet. So I want to just bring up 2022. So I'll bring this first chart up. Again, this is Standard & Poor's. It is the percentage of large cap domestic equity funds, US, underperforming the S&P 500 every year. 2022 was the year for the stock picker, wasn't it?
It was.
Every year seems to be the year of the stock picker. But so in the year of the stock picker, still majority, not by much, 52%, 51 point something, I'll round up to 52%, still continued to underperform the stock market. So the first thing I'd say is in such a rich and information and such a liquid market, it's just really hard to outperform something like an S&P 500 index, right?
Especially when you're acting at scale, right? I think for smaller stock pickers where you can create your own liquidity, there's probably an easier way to profit than if you're an active manager managing hundreds of millions of dollars, or
you can't move.
You just can't.
Sure. The second chart I'll bring up here is the average monthly dispersion by calendar year. So this basically shows the orange dotted line is the average of 23.5%. Anything above that means that more stocks are moving around in dispersion of each other. So what it means is those particular years should, in theory, be easier for a stock picker to pick the stocks because, not all boats are rising with the tide, right?
Sure.
And then anything below that, you've got everything's moving less together in tighter, which means it's harder to try and individually pick the stocks, right? Does that make sense?
Yep. So technically 2022 should have been a better year.
It's a stock pickers year. 2022, 2020, 2008, 2009, and 2001 and 02 are effectively stock picker years. This is from S&P. One thing that was particularly interesting about 2022 was that most constituents of the S&P 500 outperformed the index itself. Most constituents in 2022 outperformed the index itself. This is unusual. And I'll bring this exhibit up now, Exhibit 6, frequency distribution of S&P 500 constituent excess returns. I'll read this from Dow Jones. S&P Dow Jones. Exhibit 6 provides a final perspective on the relatively abundant prospects for concentrated active US large cap stock pickers. Even for those hypothetically selecting stocks at random, in most years for the past 2 decades and over the full period, a majority of S&P 500 constituents underperformed the index itself. In contrast, Exhibit 6 shows that in 2022, a manager selecting a random stock would have had a 59% chance of beating the S&P 500. Meanwhile, only 52% beat, and a 30% chance of outperforming the S&P 500 by 20% or better, compared with a 41% chance of selecting an underperformer and just a 15% chance of picking one that lagged by 20% or worse. So it's really just set up for stock pickers to be able to try and handpick, especially these large mutual funds or managed funds, to be able to do that. And they go on to say, in other words, those picking stocks based on coin flips were statistically likely to beat the market in 2022. For better or worse, SPDJI, Standard & Poor's, Dow Jones indices data suggests that most active fund managers were not picking stocks this way.
You should get an active manager on the show to have a chat about this topic. Discuss why their strategy is a good strategy.
I think that's a great idea. We should do a stocks topic let's do that. Let's bring someone on. You know what we should do? We should bring a couple of people on and bring a passive and an active, and I would just love to hear the debate, and I'd love to hear the conversation. I'm not saying one's right or wrong. I think there's enough ways to construct a portfolio that allows you to do both in different asset classes. And we talked last week about unlisted assets, fixed income assets, where active clearly has done much better than what the index would have. But I'm only talking about the S&P 500 here, right?
Yeah.
I'm not talking about any other asset classes. A couple of things that you may or may not have seen. I'll bring this table up now. So if you were one of those money managers that were able to outperform the market, your ability to be able to be consistent in your outperformance appears to be very, very limited. So according to the report, of the 29% of the 791 large cap equity funds that beat the S&P 500 in 2019, 75% beat the benchmark again in 2020. So that's that sort of second blue and orange column you can see. But only 9.1% or 21 of those funds were able to extend the streak of outperformance into 2022. So there's this, quartile leadership where funds land. So you might be, and typically what happens is you have a really poor manager who's in bottom quartile results for the year. They then start to see massive outflows. And you know what happens after a really bad year. We just talked about the tech, the NASDAQ 100 having a really shit year in 2022. Number one sector leading in 2023.
Yeah.
Outperforming in 2022, you're the underperformer in 2023. And there's years and years of data that shows that happens consistently.
Yeah.
Finally, last chart I want to bring up here.
Having said that, 2022, it was getting fairly frothy. Where
that was 2021.
2021.
2021 was frothy. On the January 2022, the market created the all-time high, peaked, and it was downhill from there.
Yeah.
So what are you saying?
I was just saying, it's not an easy environment to make money in a.
But it never is. It's never we're just talking today about how noisy the market is.
Yes,
and we're saying not that it hasn't been noisy. Like, it's just, I feel like constantly noisy. And the more, the Federal Reserve and the FDIC and SEC and the RBA and central banks and authorities get more and more involved in trying to control financial markets, it's just I feel like it's going to be constantly noisier.
Yeah. There's a hell of a lot of volatility at the moment.
Last chart, S&P 500. Most S&P 500 constituents underperformed the index. So in this report, I'll read this out and hopefully it explains it. Standard & Poor's found that only 22% of stocks in the S&P 500 outperformed the index itself from the year 2000 to 2020. Does that number not fascinate you?
Yep, that's
22% of stocks. 1/5 of stocks within the index outperformed the index itself. Over the measurement period, the S&P 500 itself gained 322%, while the median stock rose by just 63%. Look at that tail. Like, everything's skewed to the left. Everything's skewed to you losing.
Yeah.
Like, how do you then pick the minority of winners on the tail, right-hand tail of that distribution?
Not easy.
So anyway, there are facts. They are not my opinions. I'm just showing you the numbers. I'm showing you the facts. And so that's
the data makes sense.
I think that's why it's really hard. And so you're absolutely right. I think there is opportunity. I think there will be ability to do better or what have you. But the probability of that happening in any given year is low. If you did it in that year, the probability of that happening again the year after is even lower.
Yeah. Yeah.
I mean, you got to go to the likes of Bridgewater, you look at Berkshire Hathaway, you look at some of these hedge funds that have been around for long periods of time. Sure, there are those outliers, but they're not taking your money.
No, that's right.
So,
you can't
like, what do you do?
Yeah, what do you do?
Any other comments?
Compounding is king.
Look, I think even with the issue with like active funds management is that they're all like the fund managers are also at the mercy of the investor and the unit holders.
Yeah.
If they have one poor year of performance, they can't control outflows.
No.
And what happens when you control outflows? It's a downward
That's right.
spiral, right? And whether it's active management or passive management or whatever fund you've picked, I mean, there are some shitty funds out there that have underperformed severely. But I think as long as you allow your money to compound, you regularly contribute, and you don't keep chopping and changing, like the odds are, man, I reckon you'll do. Yeah, I reckon you'll do okay.
You do well.
You got anything for director's cuts?
No.
All right. You got nothing there?
I think I've got one tweet in there that we talked about early on.
Bring it up.
Which is breaking market news. So if you have a look at that one. Swiss regulator FINMA Credit Suisse has been given the instruction to fully write down its AT1 instruments and immediately notify the affected bondholders. Tier 2 bonds won't be written down.
I love the first comment.
First comment.
Bag holders, not bond holders.
Yeah. I had a little laugh reading that.
How do you make sense of all of this? Like, it's almost like anything is circumstantial to the extent that whatever is going on for this event or this issue, we'll decide what happens. It's not like it's you can't. There's no what's the word? There's no precedent for anything.
There's no playbook for it. So they're just basically trying to put out fires as they can, and I guess the risk that people are taking, the perceived risk, is now a lot different from the real risk.
100%.
That people are taking for these products.
So what do we do? Go and buy subordinated notes? Subordinated bank notes?
I'd want to be, first
Mate,
mortgage,
you want to be
or a deposit holder up to 250,000
or 250, or you want to go buy
Bitcoin.
Well, you can go buy Bitcoin, or you can go buy your tech stocks that have billions of $52 billion in cash.
Cash, man.
One thing. This is the UK CPI that just came out, 10.4%. They are hurting, man. And it looked like it peaked, but it seems to have clicked up again.
This goes back to the food story we did a couple of weeks ago.
The cost of food and non-alcoholic drinks rose 18%, the most in 45 years, while the 12.1% annual rise in inflation at restaurants and hotels was the biggest since 1991. Is it a supply or is it real?
Supply issue.
You think it's supply still?
Yeah. Massive supply issue. Food
prices soared, including for vegetables that have been in short supply in the UK.
I was speaking to a friend who had manufacturing. They were manufacturing a food product that was using sunflower oil or something like that.
Oh yeah.
And they've been told by the manufacturers, "Hey, we've run out of sunflower oil," because I didn't actually know this. So in addition to wheat in the Ukraine,
they do sunflower. Do they?
They're a big producer.
Come on, man.
Yeah, 100%. And there's a shortage of sunflower oil, and so now they've got to substitute other oils.
What's wrong with olive oil? Are we short of olive? Too
To
expensive.
manufacture.
What about canola? Is that cheap?
Oh, maybe canola. Maybe it was canola.
Vegetable
Sunflower
oil.
Canola. Yeah, some sort of vegetable. Anyway, so now they've got to redo taste tests.
Yeah.
The
production.
it's just a nightmare.
Change the game. You can't just you can't just replace ingredients like that.
There you go. So this is an issue, and it's happening around the world, causing massive spikes in food pricing.
So yeah, we did see the price of olive oil going up. Remember the pizza index?
Yes, the pizza index.
So cooking at
I
home.
haven't made pizza for a while.
Clearly.
After that discussion, I haven't made pizza since.
I'm just buying Domino's, mate. $10. Anyway, one other I had. I'm going to bring this chart up now. This is median asking rent in the US from Redfin. You can see it peaked. When is that? Like earlier this year, and it's come down.
Yep.
The reason why I wanted to pick this up was I still feel like the Australian economy is a good at least a year behind the US in terms of everything. Property prices, inflation, interest rates, employment, unemployment, just major economic indicators. And obviously, we've got a bit of a rental crisis here at the moment. The US had that months ago.
Yes.
It's peaked out. It's coming down now. And I wanted to just bring this up because I think if I'm going to take a punt and roll the dice, I'm going to punt that the Aussie rental market is going to turn around. What drove a lot of this is a lot more building development, building activity in the US. So you've got more supply coming onto the market. Once we see that coming through the Australian market as well, I think we need to see finance. Yeah. Yes. The caveat, however, is that we've got the fixed rate cliff. The fixed rate loan cliff.
Oh, it's happening very soon.
It's an issue.
Yep.
June quarter is when they're maturing. So not long to go before we see what the full impact of that is. Maybe it's a non-issue. Maybe it's an issue. Who knows? Who knows how we're going to deal with it all. Let's wrap up. Tips and recommendations. You got anything?
Not for this week.
All right. So I went to a restaurant yesterday. Oh. It's a fancy place you would go to, Society.
Oh, yeah. I love Society.
What do you think about that?
Fantastic.
You like it?
Yeah. I mean, they lost their head chef. I think they had a falling out.
Oh, right. Okay.
But that was very close to when it first started. And I went post that and the food was still delicious.
Yeah.
Really good.
How's the ambience?
Oh, it's all about the ambience.
It is. It's good, isn't it?
Service, the ambience.
Service is very good, I must admit. Yeah. The ambience is very good. They've got the dark woods.
I mean, they say you eat with your eyes as well, as much as your mouth and smell.
Yeah, but it's bloody dark. You can't see anything in there.
You can see the food.
Yeah, you can see the food. So if you're
an experience, yeah.
Okay, it was great experience. Like food, maybe if you're eating non-vegan food, I'm sure it's very, very good. But the vegan food was it's pretty meh.
Okay.
I'd say below average.
Right.
Yeah. They tried to
Chefs obviously aren't vegan.
Clearly. Look, they tried to do all these things, but it just wasn't
your jam.
No, it wasn't my jam.
Okay.
Wasn't my jam. So if you're vegan, don't go to Society. I'm sure it's very expensive.
They do good prawns and lobster and other.
Last week was International Prawn Day. Maybe they had something going on at Society. All right, hit us up on LinkedIn, Spotify, Google Podcast, Apple Podcast. I don't know. I think Spotify is still the biggest listener cohort. Yeah. YouTube, LinkedIn, check us out, and we'll catch you guys next week.
Cheers.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526 798. The information contained in this podcast by me and or our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.